Welcome back, everybody, to another deep dive. You ready to unlock some financial freedom secrets today?
Absolutely. Let's do it.
I'm excited for this one. We're diving into Bronson Hill's Fire Yourself this week.
Oh, yeah. I really enjoyed this book.
This book's making some pretty big waves.
Yeah.
Promising a path to replacing your active income with passive income. And get this, in just 3 years.
It's a big promise.
It is a big promise.
Yeah.
Big names like Justin Donald's a fan.
Yep.
And so is Mark Moss from The Mark Moss Show.
Big fans of this book.
So we know there's got to be something special here.
Yeah. You know what I found really refreshing is
Like that.
how Hill cuts through the noise around passive income.
It really is a buzzword these days, right?
It is. And you see so many things get labeled that way.
Yeah.
But they're not truly hands-off in a way that lets you scale up without pouring in more and more time.
Like if it were easy, everyone would be doing it.
Right.
And everyone would be rich.
Everyone would be rich, exactly.
His 10x rule is a good way to look at it.
I like that rule.
If you can't imagine your investment growing 10 times bigger without needing a ton more of your effort,
Yeah.
it's probably not as passive as you think it is.
Exactly. And he uses some great examples, too.
Oh, yeah. What are some of the ones that stand out to you?
I mean, think about single-family rentals,
Oh, yeah. That's a big one.
flipping houses,
Wow.
day trading, running online businesses.
All these things that you see these gurus selling courses on.
Exactly. And, it's not that those are bad,
Right.
but they're often way more work than people realize.
It's not truly passive income.
Exactly.
And he talks about how he had a whole portfolio of rentals, thinking that was going to be his ticket
Yeah.
to freedom.
To freedom, yeah.
And it just turned out to be a headache.
Turned into a job.
Yeah, it ate up all of his time.
Yeah.
So his passive investment test,
Yeah.
I think that's key here.
Yeah, I like that.
Minimal management after the initial setup.
Right.
And he should be able to scale it way up without suddenly needing to work twice as hard.
Exact.
That's the sweet spot.
That's the sweet spot.
Before we get into the alternatives that he suggests,
Yeah.
there's a part in this book that I found very interesting.
Oh, yeah, there's lots of interesting parts, but which one are you thinking of?
Well, his critique of Wall Street.
Yeah, he doesn't hold back.
He calls it the dark side.
It's a bold statement,
Yeah.
but I think his reasoning is pretty compelling.
Well, and he's not just some armchair theorist.
Right.
Like, this is a guy who used to be a financial advisor,
Exactly. He's been in the trenches.
and he's got a crazy story about losing $70,000 in a single-day trading options.
Oof. Yeah. That'll make you question some things.
Makes you really question the whole system.
It does. It really does.
What was his main argument against Wall Street? Do you remember?
Yeah. I mean, he argues that Wall Street is often designed to benefit itself, not necessarily the individual investor.
Yeah, I could see that.
And then you get into all those hidden fees.
Oh, don't even get me started on the fees.
Right. Like a mutual fund might say it has a 1.2% fee.
Right.
But when you factor in all the hidden costs,
Yeah.
it can be more like 3.17%.
Plus, then on top of that, you've got the financial advisor taking a cut.
Right. Often another 1.5 to 2%.
So if you're getting, let's just say, an 8% return from the market,
Yeah.
those fees are just eating up a huge portion of your gains.
They're eating you alive. And what really got me thinking was his point about how a lot of these advisors, they get paid whether their clients win or lose.
Yeah.
Doesn't that raise some questions about their incentives?
It raises some serious questions about whose interests are really being served.
It really makes you wonder if your advisor is truly on your team
Yeah.
or just looking out for their own bottom line.
It's a good point. And then you have counterparty risk, too.
Counterparty risk, what's that?
So that's the idea that if a big financial institution goes belly up,
Okay.
your investments that are tied to them could vanish.
So it's like putting all your eggs in one basket.
It can be.
Yeah.
Makes those real assets seem a lot more appealing.
Tangible things that you can hold and control.
Things like real estate
Yeah.
or precious metals.
Exactly.
But speaking of real assets,
Yeah.
what about inflation?
Yeah.
Isn't that supposed to be like the enemy?
It's what we're always told.
The enemy of building wealth.
Right. But Hill actually flips that idea on its head.
Oh, does he?
He does.
I love when people challenge conventional wisdom.
Me too. And he does it well.
So what's he saying about inflation then?
He suggests that we can actually use inflation to our advantage.
You know, that's intriguing.
And he explains it in such a down-to-earth way,
Okay, I like that.
even using a story about his daughter and the rising cost of hamburgers.
Okay, I'm interested.
Right. Makes it relatable.
I feel like I could use a hamburger about now.
Always a good time for a burger. Right?
So he's saying that we can use inflation to our advantage.
He is, and he points out that those official inflation numbers might be a little misleading.
Oh, you mean they might not be telling the whole story?
Right. He cites shadowstats.com, And they claim that inflation is actually much higher.
How much higher are we talking?
Oh, they're saying it's more like 15 to 17% annually.
Whoa.
Yeah. So if you're sitting on a pile of cash, waiting for that perfect moment to invest,
You could be losing money every single day.
you're losing purchasing power for sure.
So what does he suggest we do instead of just sitting on cash?
He outlines 3 main strategies for leveraging inflation.
Okay, I'm all ears.
So using what he calls good debt.
Good debt. Isn't all debt bad?
Not necessarily.
Okay.
He makes a distinction between things like high-interest credit card debt
Okay.
and then low-interest fixed-rate debt
Uh-huh.
that you use to acquire assets that are going to go up in value
Okay.
as inflation rises.
Yeah.
Those assets become more valuable, but your debt payments stay the same.
Oh, so it's like the debt's getting cheaper
Exactly.
as time goes on because of inflation.
Right.
Okay, that's fascinating.
Yeah, and he gives this really interesting example using a $10 million apartment building
Okay.
that was purchased with a 25% down payment.
So $2.5 million down.
Yeah.
Then what?
So let's say inflation pushes that property value up by 25%.
Over what kind of time frame?
Let's say 5 years.
Okay.
Now, the building is worth $12.5 million.
Yeah.
But the investor's equity has doubled.
To $5 million.
Exactly.
Right.
It's a powerful illustration of how that leverage combined with inflation can really supercharge your returns.
It's making me rethink my whole stance on debt.
It's worth considering, right?
Yeah.
But it's not just about good debt,
What else is he suggesting?
buying real assets.
So that's where real estate comes into play.
Real estate is a big one, but it's not the only option.
What else?
Precious metals,
Okay.
commodities,
Uh-huh.
even private equity,
Things that are going to hold their value.
things that tend to hold their value better.
Better than stocks and bonds during high inflation.
Exactly.
Now, his last strategy is leverage. And that feels risky to me.
I mean, it can be, right?
Yeah.
But he argues that when used wisely, leverage can be a powerful tool for amplifying returns.
Like that apartment building example.
Exactly. The 25% down payment allowed that investor to control an asset that was worth way more.
Yeah.
And that magnified the impact of that appreciation.
But you got to know what you're doing.
You do if your assumptions are wrong or interest rates go through the roof.
Yeah.
Leverage can backfire.
Okay, so it's all about managing the risk.
Absolutely. It's a balancing act.
He's advocating for a very different way to build wealth than what most of us are taught.
He definitely challenges the status quo.
I'm excited to hear about these unconventional investments he recommends.
Me too. It's where things get really interesting.
All right, are you ready to explore some options that we may not have even considered before?
Let's do it. Okay, so let's dive into some of these unconventional investments.
All right, lay it on me.
One that really surprised me was ATM machine funds.
ATM machine fund.
Yeah, ATM machine funds.
Now, in a world that's becoming increasingly cashless,
Right.
it seems counterintuitive.
Yeah.
You'd think ATMs are going the way of the dinosaurs.
You would, but Hill makes a really compelling case for why they can be a solid investment.
Okay, I'm listening.
Even a recession-resistant investment.
Really, how so?
He points out that there are certain segments of the population
Good.
who rely heavily on ATMs.
Like who?
Think about undocumented workers,
Uh-huh.
people with poor credit,
Okay.
people in the gig economy who need cash right away.
Oh, yeah, that makes sense.
And that demand isn't going away anytime soon.
So there's still a market for it.
There is, and these funds often generate faster returns than traditional real estate,
Oh, wow. Okay.
which makes them particularly attractive for higher income investors who are looking to offset taxes with depreciation benefits.
So it's a niche investment,
It is.
but it plays on a real need
Yeah,
that's not being met by the mainstream financial system.
exactly.
Kind of a brilliant strategy when you think about it.
It is.
Okay, so ATM funds, that's one.
That's one.
What else is on the list?
Another interesting one is private equity roll-ups.
Private equity roll-ups.
Yeah, have you heard of those?
Vaguely? I don't really know what they are, though.
So basically, it's where you consolidate a bunch of smaller businesses in a fragmented industry.
Oh, okay.
Like, for example,
Yeah.
Hill uses a great example of a 50-location car wash
A
investment.
car wash.
Yeah, okay.
50 locations.
So by combining those individual car washes under one umbrella,
Uh-huh.
you can streamline operations.
Right. You can negotiate better deals with suppliers,
Okay.
improve your marketing, ultimately increase the value of the whole thing.
Sounds interesting, but I bet it takes a lot of capital to play in the arena.
You're not wrong.
Not for the average investor.
Not for the average investor.
But a good illustration of thinking outside the box.
Exactly.
Okay, so we've got ATMs, we've got car washes.
Yeah.
What about something a little more traditional?
Like what?
like oil and gas.
Now, that sector gets a lot of mixed press these days.
For sure, with the push for renewables.
What's Hill's take on that?
Yeah, so his stance on oil and gas might surprise you.
Okay.
He's actually quite bullish on it.
Really?
He argues that the world is going to continue relying on these resources.
I mean, for the foreseeable future.
For years to come.
Okay.
And he points out that there are a lot of government incentives and tax deductions.
Available for energy investment.
Exactly.
So it's a contrarian play in a way.
I think so.
Considering everything that we hear about clean energy.
Right. But, you know, it's a reminder that understanding market cycles and being able to see value where others don't is crucial.
That's a good point.
For any successful investor.
For any successful investor.
Okay. And speaking of potentially undervalued assets,
okay,
let's talk about self-storage facilities.
Self-storage, that one's always intrigued me.
It's an interesting one.
It seems pretty hands-off.
Yeah.
And people are always going to need a place to store their stuff.
They are, even during tough economic times.
People downsizing, needing temporary solutions for their belongings.
Exactly.
What does Hill say about self-storage?
Well, he points out that they're often less management intensive than other types of real estate.
Oh, okay. Like what?
Like multifamily properties, for example.
Sure. That makes
So plus he says there's often room for what he calls value-add opportunities.
Value-add opportunities. So like if you acquire a facility that's maybe a little older.
Yeah, give it a little facelift.
Improve the marketing and then raise rents.
Exactly.
To increase the value.
That's the idea.
Okay, so there's potential there.
There is a lot of potential there.
Okay, so we've got ATMs, private equity roll-ups, oil and gas, self-storage.
It's a pretty eclectic mix.
What else?
He also touches on mobile home parks.
Mobile home parks?
Yeah.
I know those can be very cash flow positive.
They can be.
But also potentially challenging to manage.
Right.
What's his take on those?
Well, he highlights the high demand and relatively low supply.
In the mobile home park sector.
Okay.
Especially as affordable housing options become increasingly scarce.
Yeah, that's a big issue.
But he also cautions about the potential challenges related to land ownership, zoning regulations.
Feels like you need specialized knowledge for that.
You do.
To really be successful with mobile home parks.
I think so.
Okay, so we're moving on then.
Let's talk about venture capital and angel investing.
Oh, okay. So this is for people with a higher risk tolerance.
And a longer investment horizon.
This is where those 100x returns come into play.
Potentially.
But also the possibility of losing everything.
That's the risk.
It's high risk, high reward.
Very high risk, very high reward.
He uses the example of Chris Sacca.
Oh, yeah, the venture capitalist.
Who had some early success.
He did.
But then lost big during the dot-com bubble.
He did, but then he made a comeback.
Investing in companies like Facebook and Uber.
Exactly. It's a roller coaster ride.
So it's about careful due diligence and a strong understanding of the market.
Absolutely. And a little bit of luck.
Always a little bit of luck.
Okay, so we've covered a lot of ground here.
Yeah.
From ATMs to venture capital.
Unconventional for sure.
What's the last one on the list?
So he ends with precious metals.
Precious metals.
Which he considers less of an investment and more of a store of value.
Right.
It's not about chasing those sky-high returns.
Right.
It's about preserving wealth.
And hedging against inflation.
Exactly. Gold and silver have been used as money for thousands of years.
They're not tied to any specific government or financial system.
And he reminds us that until 1933, you could exchange a $20 bill for an ounce of gold.
Wow.
It's crazy how the system has changed.
It really is.
He sees precious metals as a way to hold wealth outside the traditional system.
Okay.
Protect against inflation, avoid that counterparty risk.
Yeah.
He even suggests using them as collateral for loans.
Oh, interesting.
So you can maintain liquidity while still holding on to those hard assets.
So even if you have a great strategy and you're open to exploring all these options, how do you find the best deals?
That's a great question, and that's where deal flow comes in.
Deal flow.
Which he emphasizes as a crucial element of success.
He even calls it the lifeblood.
The lifeblood of any successful investor.
That's a strong statement.
Yes.
So you're telling me it's not just about sitting back and waiting for opportunities to come to you.
No, you got to be proactive.
He has that anecdote about getting a call about that car wash opportunity.
50 locations.
Yeah.
Right? And that came about because of his network and his reputation as a savvy investor.
So it's about being in the right place at the right time.
It's about knowing the right people and having the right information.
So how do we cultivate that kind of deal flow?
Well, he offers some great suggestions.
Lay 'em on me.
attending industry events,
Yeah,
conferences,
I-
to network with other investors,
Okay.
building relationships with people who are already in the deal flow, joining mastermind groups
Okay.
or investment clubs.
That provide access to those exclusive deals.
Exactly. And he emphasizes something else too,
What's that?
responding promptly
Okay.
and thoughtfully.
To any deal proposals that come your way.
Even if you're not interested,
That's a good tip.
it's about building a reputation
As a serious investor.
as someone that people want to work with.
So that when those great opportunities arise,
You're top of mind.
you're the first person they call.
Exactly.
But even if you have that deal flow,
Yeah,
you need to know how to analyze the deals.
absolutely.
To determine if they're right for you.
It's a critical skill.
So let's talk about deal analysis. All right, deal analysis.
Yeah,
It feels like this is where things could get really overwhelming.
it can be for sure.
I mean, there's so much to consider, right?
There is.
The market,
Yeah.
the numbers, the team behind it.
The team is huge.
Where do you even start?
Hill breaks it down into a really clear three-pronged approach.
Oh, okay. I like that.
Team
Okay.
and deal.
All right, market, team, deal.
And starting with the market,
Okay.
he really stresses that choosing the right market is absolutely crucial.
It's not just about chasing the latest trends.
Right. It's about finding a market where you have some kind of edge.
Some kind of edge. So like what?
Maybe you have existing knowledge
Oh, okay.
or experience
Eh.
or even just a genuine personal interest.
I love that he emphasizes personal interest.
Yeah.
It makes sense that you'd be more motivated to learn about a market
Right.
if you're actually passionate about it.
Absolutely. And he uses his own background as an example.
What was his background?
He was in medical device sales.
Oh, okay.
So he's naturally drawn to healthcare-related investments.
Because he understands that world.
Exactly.
Yeah.
But it's not enough to just like a market.
What else do we need?
It also needs to have strong growth potential.
He talks about the Sun Belt region, right?
He does the population growth, the job creation.
It's really attractive.
For real estate investors, yeah.
But he's not saying that everyone should just go buy property in the Sun Belt, right?
No. The key is to do your own research.
Look at the trends.
See if a particular market aligns with your goals.
Your risk tolerance.
Exactly.
So market first, then what?
Then you look at the team.
The team.
Yeah, the operating team. He's really adamant about this.
What does he say?
He says even the most promising market or investment can go sour if the team behind it isn't solid.
Yeah. Because you're trusting them with your money.
You are.
Relying on them to execute that plan.
Exactly. So what are you looking for?
Track record.
Experience, expertise. Those are all givens. But Hill digs a little deeper.
Where does he go?
He talks about communication style, alignment of interests, even cultural fit.
Cultural fit. I wouldn't have thought of that.
Yeah, it might seem a little unusual, but he argues that it's crucial.
How so?
You want to work with people whose values and communication style mesh well with yours.
So it's not just about the numbers.
No, it can make a huge difference in your overall experience and your peace of mind as an investor.
And he shares that story about the bad experience he had as a passive investor.
Oh, yeah, where he wasn't kept in the loop.
Quite a major issue.
Right, and it really soured the whole deal.
You want to be kept informed.
Transparency is so important.
Especially when things aren't going perfectly.
Exactly. You want operators who are proactive, who communicate openly.
Because no investment is without risk.
That's true.
So you want a team that you can trust.
To handle those challenges effectively.
Okay, so market, team, what's the final piece?
The deal itself.
Of course.
Yeah, he encourages approaching every deal with a healthy dose of skepticism.
Okay, so don't just take their word for it.
Exactly. Do your own independent research. Look beyond just those projected returns.
Consider the downsides.
Consider the downsides. And this is interesting.
What's that?
He says be okay with both the best case and worst case scenario.
Before you commit.
Before you commit.
He has that example about the tech company, right?
Yeah, the potential upside was huge, but so was the risk.
And he went in knowing he could lose big.
But he was comfortable with that.
Because the reward was worth it.
Exactly.
It's a good reminder that risk is inherent in every investment.
It is, and understanding your own risk tolerance is crucial.
You got to be prepared for both the wins and the losses.
Couldn't have said it better myself.
And even experienced investors make mistakes.
Everyone makes mistakes.
So it's about doing your due diligence.
Absolutely.
Getting advice from trusted advisors.
Yep.
Being willing to walk away if something doesn't feel right.
Your gut feeling is important.
But how do you know if you're actually getting a good deal?
That's the million-dollar question, right?
Yeah, the market's always fluctuating. Prices go up and down. How do you avoid buying high and selling low?
That's where his concept of the contrarian edge comes in.
The contrarian edge.
He argues that most investors, especially beginners, they fall into this trap of following the herd. They buy when everyone else is buying.
Fear of missing out.
Driven by FOMO.
Yeah.
And then they panic and they sell when the market dips.
Locking in losses.
Exactly. It's that classic cycle of greed and fear.
Driving irrational decisions.
Driving those emotional decisions.
So what's the antidote?
He says you got to develop a contrarian mindset.
A contrarian mindset.
Oh, kinking for your slack.
Questioning conventional wisdom.
Being willing to go against the grain.
He uses the example of John Templeton, right?
He does, who made a fortune investing in undervalued stocks during the Great Depression.
When everybody else was afraid.
When everyone else was running for the hills.
It takes guts to do that.
It does, but his patience and discipline paid off.
So it's about spotting opportunities that others are overlooking.
Being willing to zig when everyone else is zagging.
But it's not just about gut feeling.
No, he also talks about understanding market cycles.
Okay.
Using key indicators to identify those undervalued assets.
Like what kind of indicators?
He talks about things like price-to-earnings ratios for stocks, cap rates for real estate.
Yeah.
It's about having a framework to evaluate a deal objectively.
Beyond just the hype.
Beyond the hype and the fear.
You know, with all this talk about investments and deal flow, financial freedom is about more than just money.
It's about what that money allows you to do.
The life that it enables you to live.
Exactly. And Hill addresses this really well.
Yeah, what does he say about it?
He emphasizes the importance of aligning your financial goals with your values.
With your vision for your life.
For your life, for your legacy.
He asks some really interesting questions.
He does.
What do you want to be said about you at your funeral?
Ooh, that's a good one.
What would you do if money were no object?
They really make you stop and think.
It's about more than just accumulating wealth.
It's about using that wealth to create a life of meaning and purpose.
To make a positive impact.
He talks about significance.
Significant.
Using your wealth and your influence to make a difference.
Whether it's through philanthropy,
mentoring,
starting a business that aligns with your values.
The possibilities are endless.
It's about identifying your passions.
And using your resources to support those causes you care about.
He also challenges readers to think about their legacy.
What do you want to be remembered for?
What impact do you want to have?
It's powerful stuff.
These are big questions.
Big questions.
But essential to consider as you're building your financial future.
I agree.
So we've covered a lot in this deep dive into Fire Yourself.
A lot of ground.
Hill's unique perspective on passive income.
Yeah.
His strategies for leveraging inflation, reducing your tax burden.
Analyzing deals.
We talked about those unconventional investment opportunities.
Some really out-of-the-box thinking.
And of course, the importance of deal flow networking and education.
Lifelong learning is key.
And his message about purpose, significance, and legacy.
It's inspiring stuff.
It's a book packed with valuable insights and practical advice.
But at the end of the day, it's up to each individual to take that information and apply it.
To their own life.
To their own financial journey.
Hill provides the roadmap, but you have to choose the destination.
And start walking.
So if there was one key takeaway for our listeners,
what would it be?
What would it be?
I think it would be this. Financial freedom is not a destination.
Okay.
It's a journey.
I like that.
It's about constantly learning.
Adapting. Making smart choices. Taking calculated risks.
Aligning your financial goals with your values.
And using your resources to create a life that is both prosperous and meaningful.
Well said.
To our listeners out there, what will you do today to start building the life you dream of?
Yeah. What's that first step on your path to financial freedom?
Share your thoughts with us in the comments below.
Let's keep this conversation going.
And support each other on this journey.
We're all in this together.
And be sure to check out the show notes for links to Hill's companion course and other resources.
That can help you along the way.
Thanks for joining us on this deep dive into Fire Yourself.
Until next time, keep learning, keep growing, and keep striving for that life you were meant to live.